Hello, it's FarmSense back again with another episode, this time on what is working capital. Alright, let's get right into it. Working capital is basically the difference between current assets minus current liabilities. Examples of current assets include accounts receivable, cash on hand, and pre-bought inputs such as fertilizer or other items that can be used throughout the production season. Examples of current liabilities include anything owed current within the year, equipment depreciation, and realization of something that will be lost and or must be paid for to upkeep or replace within the year that will directly affect the cash flow of the business. Working capital is important because, think about this, in ranching and farming, working capital gives you financial freedom as well as resiliency from going bankrupt within the year. If you are thinking more in the short term, having excess cash on hand is beneficial because it means you're resilient, free to make deals, etc. If I have an excess of working capital and my assets to liabilities ratio equals 2 to 1, that means I have more money than bills. Whatever I have left in the bank after all operating expenses are paid, that's working capital. Farming is a highly input-intense industry, meaning a solid working capital puts you in a financially safe place. Two very quick examples here. Our rancher is yearly considering working capital when it is time for herd replacement. Although the herd returned a gain of new calves, the loss and replacement of lost animals must too be considered to maintain optimal profitability. Our farmer is yearly considering working capital when costs rise, and they know that productivity must follow in order to protect overall profitability. Equity is where wealth is stored at the end of the day, what you own and what you can get out of it. This involves items such as the herd and its productivity, land and its productivity, equipment, etc. Of course, depreciation of items such as equipment must be considered as part of the equation as well. Working capital is whatever I have left in the bank after all operating expenses are paid. Intermediary term debt is debt that will mature in 2 to 10 years, such as machinery and other equipment. Long-term assets can include things such as machinery, vehicles, buildings, and land, against which money may be borrowed. You can find more content like this on our site at farmsense.unl.edu, as well as our Twitter at farmsense_UNL. Thanks for watching!